Tyler has $34,000 in student loans and has been told his entire life that student debt is America's biggest problem. Jordan has $41,000 in auto loans across 2 vehicles and has never once thought of himself as part of a debt crisis. For the first time ever, auto loan debt has surpassed student loans as America's largest consumer debt category. Auto loan debt in America reached $1.685 trillion in early 2026, officially passing student loans at $1.658 trillion. This is not a small statistical blip. It is a fundamental shift in how and what Americans choose to borrow for. Let's run the real math on what this shift means, why it happened, and what it costs the average borrower today. Tyler's $34,000 in student loans represents an investment. His degree increased his income by $22,000 yearly. Jordan's $41,000 in auto loans finances 2 depreciating assets that lose value every month regardless of payments. This is the first structural difference between the 2 debt categories that headline statistics rarely explain clearly. Student loan debt can produce a return. A degree in engineering or nursing typically pays back its full cost. Auto loan debt produces no return. The vehicle depreciates while the borrower pays interest on the declining value. The average new car loses 20% of its value in the first year and roughly 50% within just 5 years of purchase. Jordan financed a $28,000 SUV 3 years ago. It is now worth $16,800, while he still owes $19,400 on the loan. Jordan is underwater. He owes more than the asset is worth and cannot sell it without bringing cash to close. Tyler's $34,000 student loan balance represents a credential that will never depreciate the way Jordan's SUV does. Now let's look at why auto loan debt surpassed student loans. The answer reveals something important about behavior. Student loan growth slowed. Federal loan origination dropped 18% between 2020 and 2026 as enrollment patterns shifted. Auto loan growth accelerated. Vehicle prices rose 34% between 2020 and 2026, pushing average loan balances far higher. The average new car transaction price in America hit $48,200 in early 2026, up from $35,600 just 6 years ago. That $12,600 price increase required borrowers to finance $12,600 more per vehicle than they did just 6 years prior. At the same time, loan terms extended. 72 and 84-month auto loans now represent 42% of all new vehicle financing. A borrower financing $48,200 over 84 months at 7.4% pays $892 per month and $26,700 in total interest overall. That same borrower financing $35,600 over 60 months at 4.1% paid $657 per month and just $3,800 in total interest. The monthly payment rose $235 and total interest paid increased $22,900 from the same fundamental purchasing decision. Now let's look at who carries this debt. The distribution reveals which Americans are most exposed to this crisis. Borrowers aged 25 to 34 carry the highest average auto loan balance at approximately $24,800 per borrower in 2026. This group also carries the highest student loan balances. They service both debt categories at peak levels at once. Borrowers in this range paying both student and auto loans allocate an average of $1,340 per month to debt service. That $1,340 monthly on a median income of $58,000 per year represents approximately 27.7% of gross monthly income. Financial advisors recommend keeping all debt payments below 36% of gross income. 27.7% is already dangerously close. Add rent or a mortgage, and many borrowers in this age range are well above the recommended total debt service ratio. Now, let's look at delinquency, because this is where auto surpassing student loans becomes genuinely alarming today. Auto loan delinquency rates, borrowers 90 or more days past due, hit 3.1% in early 2026, highest since 2010. Student loan delinquency stays low because federal loans offer income-driven repayment and forbearance as protection. Auto loans offer no such protection. A missed payment triggers immediate credit damage and repossession within 90 days. In 2025 alone, approximately 1.6 million vehicles were repossessed, a 23% increase from the prior year's total volume. Repossession does not eliminate the debt the lender sells at auction, and the borrower owes the remaining deficiency. Jordan's SUV repossessed today would sell at auction for $13,000. He would still owe $6,400 in deficiency balance. That deficiency accrues interest, damages credit, and can be pursued by collectors for years after the repossession. Tyler's student loans, if he defaults, enter a federal program, income-driven repayment, and forgiveness options remain. Now let's look at Tyler and Jordan's 5-year trajectories from their current debt positions going forward today. Tyler pays $380 per month on his student loans at 5.8%. His balance will be eliminated in approximately 9 years. His credential, meanwhile, continues producing $22,000 per year in additional income, $198,000 over the next 9 years. Tyler's net return on his $34,000 debt over 9 years is strongly positive when income premium is weighed against cost. Jordan pays $580 per month on his first vehicle and $312 on his second $892 total monthly debt obligation combined. His 2 vehicles will depreciate by approximately $18,000 combined over the next 3 years despite full payments made. Jordan's net position over 5 years is negative. He will have paid $53,520 while his assets are worth far less. The difference is not discipline. It is about what the debt actually finances in the first place structurally. Student debt finances a credential that builds earning power. Auto debt finances a depreciating asset with zero return. Now let's address 3 common arguments made in defense of high auto loan balances by borrowers in Jordan's position. Argument 1. I need a reliable vehicle for work, and a used car would cost more in repairs than the loan payment. The average annual repair cost for a 5-year-old certified pre-owned vehicle is approximately $900 per year total. A $900 annual repair bill is $75 per month. Jordan's payments cost $892 per month, plus $400 in insurance monthly. Argument 2. I got a low rate, so financing made more sense than paying cash and investing the difference instead. This argument works when investment returns beat the loan rate, but it ignores depreciation, which erases the spread. A 5% loan rate with 20% first-year depreciation produces a net loss of about 15% on the finance portion in year 1. Argument 3. Monthly payments fit my budget, and I can comfortably afford the payment within my current income. Affordability and optimality are different. Jordan can afford $892 per month, but that amount invested builds $73,000. If Jordan invested $892 per month for 5 years at 10% return, he would have approximately $68,700 in portfolio value. Instead, Jordan has 2 depreciating vehicles worth less than their loan balances and 0 investment growth to show. Now let's look at what $1.685 trillion in total auto loan debt means at the macroeconomic level for the economy. When auto delinquencies rise, banks tighten lending, reducing credit availability across all consumer loan types. Tighter credit means fewer car sales, reduced dealership revenue, lower manufacturer profits, and potential job losses. The auto industry employs 4.5 million Americans. Credit tightening and auto loans ripples across the whole economy. A sustained auto loan crisis would impact GDP, employment, and consumer spending far beyond the auto sector itself. This is why auto loans surpassing student loans is not just a planning story, it is a macroeconomic warning signal. Now let's look at 5 decisions that separate smart borrowers from those who fall into the auto loan debt trap. Decision 1. Buy used rather than new and target vehicles 3 to 5 years old with certified pre-owned warranties. A 3-year-old version of Jordan's SUV costs approximately $22,000. $26,000 less than the new version he financed. Decision 2. Finance for the shortest term you can manage rather than extending to 72 or 84 months for lower payments. A 48-month term on $22,000 at 6% costs $517 per month. The vehicle is paid off before major depreciation compounds. Decision 3. Keep total vehicle costs including payment, insurance, and fuel below 15% of monthly take-home pay. Jordan's 2 vehicles cost approximately $1,700 per month total, representing 35% of his take-home pay every month. Decision 4. Never finance a vehicle whose loan balance exceeds its projected value at the loan completion date. Decision 5. Treat every car payment as opportunity cost and calculate what that amount builds if invested instead. Jordan, calculating $892 times 60 months at 10% return would see $69,000 in foregone investment value from auto loans. That $69,000 is not abstract. It is the actual portfolio he would have built driving a paid-off used car instead. Tyler is not superior to Jordan. He simply borrowed money that can produce a return versus money that produces nothing. The $1.685 trillion auto loan debt is not a crisis of borrowing too much. It is a crisis of borrowing the wrong things. Borrowed wrong means financing depreciating assets at extended terms for amounts exceeding the asset's value at payoff. The path out is simple: buy used, borrow short, keep payments below 15% of take-home, and invest the difference. So the next time a finance manager slides a payment across the desk toward you, remember one thing before you sign. The question is not whether you can afford the payment, it is what that same monthly amount builds if invested instead. Because that calculation, not the sticker price, not the rate, is the only complete picture of what a car loan costs.